Doug. Thanks for joining me today.
Sure, Becky.
Today we're going to be discussing a few topics related to the mortgage industry, specifically FHA loans versus conventional loans, predatory lending practices, and the art of determining mortgage rates. So tell me, what exactly is the difference between an FHA loan and a conventional loan?
Good question. FHA loans are federally insured by HUD, whereas a conventional loan is privately insured. Conventional loans are backed by Fannie and Freddie, which we've heard a lot about in the last couple of months. FHA loans are backed by HUD, Housing and Urban Development. FHA loans have a little bit more of an advantage from an interest rate standpoint in that risk-based pricing, which applies to conventional loans, whereas your interest rate is going to be determined by your credit score, is not necessarily applicable on an FHA loan. So anyone with a 620 credit score or better on an FHA loan is going to get the same great rate.
Okay, right. And about what is the minimum credit score for an FHA loan?
585 is the minimum.
585.
That's correct.
The limit for an FHA loan is what, 271?
271 for FHA. Conventional, of course, goes up to 417. So conventional loan's not going to, or an FHA loan's not going to be applicable for every buyer.
Right, but for somebody looking to get a loan of $271,000 or less.
It's a great way to go.
Great. Okay, well, in the past, when a seller was comparing an offer using conventional financing versus FHA financing, with all other terms being the same, conventional always won out due to seller-specific fees associated with an FHA loan. Is that still the case?
No, it's not. Approximately 2 years ago, those guidelines were changed. Previously, there were fees that the buyer was not permitted to pay on an FHA loan. So when a seller was weighing a conventional offer for their home and an FHA offer, if it wasn't the exact same sales price, the seller would have netted more because of non-allowable fees that were passed on from the mortgage companies to the sellers.
Right.
That has all changed, and the buyer now is permitted to pay all of their closing costs.
Awesome. So an FHA buyer would not be at any sort of disadvantage because of FHA financing?
Not at all. The seller would net the exact same on either transaction.
Okay, great. Next topic. We hear a lot on the news today about predatory lending practices. What should a buyer look out for when shopping for a mortgage to make sure that they're not a victim?
Well, clearly, and one of the first things that I do, and I would encourage every prospective buyer to do, is to get a good faith estimate as well as a truth in lending disclosure statement from whoever they're talking to, so that they truly know what fees are going to be associated with the purchase of that property, as well as what is the APR. They may be shooting them a low interest rate, but the APR may be high because they're loading it up with a lot of fees. You know, in today's environment, and especially with the subprime industry coming to a screeching halt and really not existing anymore, we're not seeing so many of those high-cost loans anymore.
That's good.
And those higher interest rates for people that were on, you know, a B-type paper loan, someone's that's credit was not good enough to get into a regular conventional or FHA type financing.
Right. So when they're looking at the good faith estimate, isn't it true that some lenders don't put on all the third-party fees?
Oh, absolutely. I mean, we see a lot of good faith estimates that, quite frankly, are not accurate. There are certain fees that are going to be incurred when purchasing a home. There are going to be title company third-party fees, there's mortgage company fees, there's setting up of escrows for taxes and insurance and prepaid expenses. And a lot of times some of the companies, and the ones that we see it from the most, are internet-type companies, and they don't always necessarily estimate those third-party fees. So their initial estimate may look a little bit better up front, but I promise you those fees will be charged at closing.
And that's where the truth in lending documentation comes in.
Absolutely. Well, the truth in lending disclosure statement should include all the fees that you're being charged. And so if you were to present one to a buyer up front and not include any third-party fees, there's an initial disclosure that's given at loan application. There is a final truth in lending disclosure statement that matches the exact terms of the transaction. That's part of the closing package. If there's a huge difference in that, well, then obviously somebody was not disclosing all the fees up front.
Wow, okay, so it makes good sense to get a good faith estimate and a truth in lending disclosure.
Absolutely.
But is there anything that a buyer should look out for that may not be in either of those documents? Like, what about the old bait and switch?
Well, you know, if the old adage, if it sounds too good to be true, it is. So
Right.
a lot of lenders, a lot of things that we've seen here recently are lenders advertising absolutely no closing costs.
Right.
Well, okay, any lender can get rid of their closing costs, but those closing costs are a real factual cost in purchasing that house. So where do they go? Well, they go into the interest rate.
Okay.
You know, if every time I get a good faith estimate that has no closing costs, again, I can do the exact same thing. They're just taking those closing costs and building it into the interest rate. Now, if you're going to stay in the house less than 2 years, sometimes that's a good way to go. You're going to take a little bit higher interest rate, and you're going to save a couple of $1,000s at closing. But if you plan on being in that house over a 2-year period, then it makes no sense to do that. You're better off paying all of your own fees and having the benefit of a lower interest rate throughout the term of the mortgage.
Okay. So knowing that interest rates are not everything when it comes to choosing a lender, let's spend a little time discussing those rates. It seems like nowadays they're on a roller coaster ride. What affects their rise and fall?
Well, lately, look at our markets and what's been going on with our economy. You know, when you look at where housing is and things of that nature, one would think that interest rates would actually be a little bit lower. Sometimes when there is a run on stocks and we see a lot of money going into the stock market, we see money coming out of the bond market. So the yields will rise a little bit on interest rates. It's hard to predict, you know, where rates are going, but from a historical standpoint, rates right now are great. It's a great time to be buying a home.
Right, I agree with you. So what can a person do now to help ensure that they get a good rate for a future loan?
Well, they need to make sure they're in the right loan to begin with. They also need to make sure that their credit is good and that they're paying their bills on time. Fannie and Freddie and all conventional financing has gone to risk-based pricing. And what that means is that if you and I sit here and we have the exact same purchase price we're looking at, we're putting down the exact same amount of money, but you've got a 750 credit score and old Doug hasn't been as good with his credit and has a 650 credit score, I'm going to pay for that. I'm going to get a higher interest mortgage. It's risk-based pricing. And again, that goes back to FHA, whereas FHA, that's not necessarily true. So it's really important. Pay attention to your credit. Make sure you're paying your bills on time.
So people that are looking at the daily rate, say in the newspaper or online, that's not necessarily going to be the rate for them.
Gosh, not at all. And you know, years ago we were able to post what approximate rates were on a daily basis, and now there are so many factors. You know, if you have a minimum down payment, if you have a lower than top-notch credit score, you can expect to have a higher interest rate than someone that has a 20% down payment and a credit score that's above 720 or even above 740. So it's really important to know what is your specific scenario. And this is where getting pre-qualified makes such great sense.
So you said something just a minute ago that I want to emphasize. You said not only is it your credit score, but the amount of your down payment can affect your rate too. Is that correct?
Absolutely.
Okay, well that's good information to have. So, Doug, do you have any last thoughts you'd like to leave us with?
Well, one of the things I've been asked repeatedly here in this market is it a good time to buy? Where do you think home values are going to go? And while it's true that you know, in our nation there are different cities and different regions that have experienced anywhere from a 20 to 26% decrease in home values, which that's a lot, and I can certainly understand why people might be shy to jump out and purchase a home. But here in this market, the Dallas-Fort Worth market, that's just not the case. We've seen maybe a 2 to 2.5% decline in values over the last 12 months, and it's a great time to buy.
Well, thanks for meeting with me today, Doug.
You bet.
I really appreciate your time.
My pleasure. Thanks, Becky.
Thank you.